So high yields, low risk, monthly payouts. Covered call ETFs right now are all the rage, but they're not really for everybody. So what I'm here to do is give you the basics 101 guide to how they work, why they pay so much, and the one market condition where they absolutely fail. Before we get going, I do want to say this is going to be a two-part series. In the second part, I'm going to go into the actual ETFs, what their yields are, the pros and cons. So take this time to subscribe and hit the notification button so that you can be aware when I launch that second part. In today's market, everybody is searching for income. Interest rates are up, inflation is a concern, and traditional savings accounts just are not cutting it. That's why funds like JEPI, QYLD, and XYLD have exploded in popularity. I mean, who wouldn't want to see 10%, 11%, even 12% annual yields hitting their account every single month? It sounds amazing, but as with anything that sounds too good to be true in finance, we need to peel back the layers and understand the mechanics. Before we get into the ETFs, let's understand the core strategy they use, the covered call. Don't let jargon scare you, it's actually quite simple. Imagine you own 100 shares of Apple stock. You believe Apple might go up, but you also think it could trade sideways for a bit. You want to generate some extra income from those shares. What you can do is sell a call option on your Apple stock. When you sell a call option, you're giving somebody else the right but not the obligation to buy 100 shares of Apple from you at a specific price called the strike price, on or before a specific date, the expiration date. In exchange for giving them the right, you receive an immediate payment. This payment is called the premium. This is covered because you already own the Apple shares. So if the stock price goes above the strike price, you might have to sell your shares. If it stays below, the option expires worthless and you keep the shares and the premium. That premium is your income. Now scale that up to an entire fund. A covered call ETF essentially does the same strategy, but with a massive, diversified portfolio of stocks. They own hundreds, sometimes thousands of shares of underlying companies. Think S&P 500 stock, NASDAQ 100 stocks, or even specific sectors. So instead of you selling one call option, the fund manager sells thousands of call options across their portfolio. They collect all those premiums month after month and then distribute a large portion of that income directly to you, the shareholder, as a dividend. This is why the yields are so high. They aren't just paying you a tiny fraction for a company profit. They're paying you directly from the consistent income generated by selling these options. It's like a financial landlord collecting rent from multiple tenants. This brings us to perhaps the most crucial concept to understand before investing in covered call ETFs: total return. When most people look at an investment, they often focus on the dividend yield. A 10% yield, a 12% yield sounds amazing, but what they sometimes miss is the impact on the share price of the ETF itself. Remember our Apple example? If Apple's stock price skyrockets above your strike price, you have to sell your shares. You miss out on all that upside profit. Covered call ETFs operate under the same principle. When the underlying stocks in their portfolio experience significant growth, the fund is often forced to sell those shares at the strike price they chose. This means the ETF typically captures very little, if any, of the capital appreciation that a traditional buy and hold stock or index fund would. So, when are covered call ETFs a good fit? I would say there's a few scenarios where they would be good, and I'm going to give you 4 of them. Probably the most obvious is income generation. If your primary goal is consistent high income, perhaps in retirement to cover living expenses, these funds are excellent. They provide predictable, monthly distributions. The second bucket would be in sideways or slightly bearish markets. This is where they truly shine. If the market isn't going up significantly, but isn't crashing either, the premiums they collect are pure profit without giving up much growth. They can also provide a small buffer during mild downturns. Third bucket, reducing volatility. Because they collect premiums, they can provide a smoother ride than a pure equity fund, as the income can offset some small declines in the underlying assets. And the fourth bucket, diversification of income streams. So if you want a well-rounded portfolio, they can add an income component that behaves differently than bond yields or a traditional stock dividend. Okay, so there's also a flip side. When do they stumble? So if you have a strong bull market, this is their Achilles heel. Because if the market's soaring, these funds are going to underperform a traditional index fund. So think about it. You're giving up all that massive upside in exchange for income, and that trade-off can be costly. If you're a young investor, if you're in your 20s and you're looking to grow your wealth over 20, 30, 40 years, a covered call ETF is likely not your primary vehicle because you're going to be missing out on the compounding capital appreciation that makes long-term capital investing so powerful. Complexity. And while I've simplified it, or at least I've tried to simplify it, option strategies do add a layer of complexity, and it's important to understand the strike prices chosen, the expiration dates, and how the fund managers adjust their strategy. I'm going to go more in depth into this in part 2. And finally, tax efficiency. Now, those high distributions are typically taxed as ordinary income, which can be less tax efficient than qualified dividends or long-term capital gains, especially in a taxable brokerage account. So please always consult a tax professional. So as you can see, covered call ETFs are a powerful tool, but like any tool, you need to use them for the right job, understand their mechanics, appreciate the total return concept, and decide if sacrificing growth for high income fits your personal financial goals. What are your thoughts on covered call ETFs? Do you own any? Let me know in the comments below. And if you found this video helpful, please give it a thumbs up, subscribe for part 2, and hit that notification bell so you don't miss it. Thanks for watching. I'll see you next time.